Hi, this is Tenzesta Marie Smith with Keller Williams Realty, and here we are again today, interview with an expert. Today we're going to talk about mortgage. So as we understand about mortgages, today we're here with Vanessa Mancinas from Home USA Mortgage. Hi Vanessa, how are you today?
I'm doing well, how are you?
Great, thanks for coming, really appreciate it.
Thanks for having me.
So today we're going to talk about mortgage and give our audience a better understanding of the importance and the role that mortgage and a proper mortgage company and loan officer play in this role. So I have a couple questions for you, is that okay?
Yes, of course.
Thank you. So what role does the mortgage play in home ownership?
Yeah, so you're going to get a mortgage when you want to finance the property that you want to own. So the mortgage is essentially going to be what you're paying back, and the property that you're purchasing is going to be used as collateral until you finish making those payments and officially fully own the home.
Okay, it sounds pretty straightforward. I can't afford it on my own. I'm going to go to a lender, a reputable lender, and I'm going to ask them to qualify me for a mortgage, and then that's how I'm going to purchase the property.
Yes.
Okay, so with your help, absolutely.
Of course.
Okay, so I understand what a mortgage is. So what are some of the common types of mortgages? Because we hear a lot of acronyms floating around. What are the common types?
Yeah, so you're going to have a conventional mortgage, which is going to be conforming, which is going to have probably the least restrictive requirements for approval. Then you're going to have an FHA mortgage, and that one's going to be backed by the Federal Housing Administration. So those are government insured mortgages. Sometimes they will have a little bit more lenient requirements and lesser down payments. Okay. Then the other two common types are going to be VA loans, which are going to be for people who have served in the military, okay, and they're eligible for those products. And then we have USDA loans, and those will have a little bit different requirements as far as where you can purchase. So
okay.
Those are going to be probably the four most common types.
Okay, and does your organization lend with all of those types of mortgages?
We do, yes.
Okay, fantastic. Okay, so terminology, and I got this off of my Facebook page. I had a client that asked, what's the difference between an interest rate and an APR?
Sure. So interest rate is going to be the rate that you get that's going to be towards the principal balance. So if you take out a loan for $250,000 and you have an interest rate of 4.25%, that's going to be the rate that you're paying back that principal. And so you will pay a monthly payment based off that principal and interest combined.
That makes sense.
Yeah. So the APR is actually going to be an overall calculation of all of the costs involved in the loan. So factored in there, you're going to have your interest rate. You'll also have like any fees that were associated with the loan, okay, and that's a separate rate that's calculated.
So for the interest rate, which seems to be pretty straightforward, but the APR says how many other fees are added into that, and then they come up with this APR. So if I have a competitive interest rate, but when I look at the APR, it's this enormous amount, then that tells me that maybe not all lenders are created equal, huh?
Yeah, so you definitely want to compare on fees, right? And you want to make sure that you're getting the most competitive quote whenever you're shopping for a mortgage, but you really want to be mostly concerned with your interest rate because that's going to be what you're repaying.
Okay, good to know. So tell me about pre-approval. As a realtor, pre-approval letters are just passed around. And I know that for from each of my buyers, we need a pre-approval letter to show that we are a strong candidate when we're putting an offer in. Can you tell me about how pre-approval works with your organization?
Definitely. So I think it's important when we talk about pre-approvals that we talk about two things. We talk about pre-qualifying and then a full-on pre-approval. Okay. I have had some clients that come to me that tell me, and agents as well that I work with, hey, I have a client who's been pre-qualified. Maybe that involves like a simple credit check, and maybe it involves some of the terms on what they're looking to purchase. But where pre-approval is going to come into play is when you have all of the documents from the borrower and you look at everything up front, just like an underwriter would. And that's what we do at Home USA Mortgage, like in-house underwriting, so we can see the full picture and avoid any problems for the client or any surprises once we submit their loan.
So it sounds like your organization is a little different there, that you actually do all of that due diligence that an underwriter would do up front. So it's less probable that our deal could fall out in the end.
Exactly. Yes. Okay. We want to make sure that we are doing everything we can to prevent any surprises in the transaction.
Good. Okay, and one of the biggest issues that and concerns and questions that people have is going to be credit.
Sure.
So credit, I know, is a huge factor. Can you tell me about credit score and its relevance in getting a mortgage?
Yeah, so your credit score is going to be important. It's just like any other financing. The higher the credit score is, the better the terms are going to be on the loan. But you do want to aim somewhere for at least 600 plus to be eligible for a full loan approval. Some loan products are going to be more lenient towards a lower credit score, but the credit score is just going to factor into the rate that you're going to be getting. And then also, if you have mortgage insurance on the loan, on a conventional loan, the credit score will decide what that amount is as well.
Oh, okay. So the mortgage insurance, tell me a little bit about mortgage insurance and what some of the typical ranges are of mortgage insurance and why you need it and what it is.
Yeah, of course. So if you don't put 20% down on the purchase of your home, you're going to have mortgage insurance depending on the type of product that you get. So on all FHA loans, everyone is going to pay the same amount in mortgage insurance for the life of the loan based on their purchase price. On conventional loans, you're going to determine your mortgage insurance based off of your credit score. So that's where they're going to vary. And then on conventional loans, once you have 20% equity paid in the home, then your mortgage insurance will go away. So you no longer have that expense.
Okay, so with an FHA, it's going to remain there for the life of that loan. With a conventional, you'll be able to look at loan to value,
yes,
and then be able to make that decision on how you go about getting it taken off. That's good to know.
Yeah.
So mortgage insurance, who does it really benefit?
Yeah, so mortgage insurance is one of these things that nobody likes because it doesn't benefit the homeowner at all. But pretend I'm the bank and I'm making a loan for you and I loan you $400,000. I've given you this loan with a minimum down payment. Since you haven't paid the 20% down payment, I'm taking out a mortgage insurance policy in the event that you were to default on the loan or not pay. So I have some protection and can recover.
Okay, so I understand. So you're saying because I don't have 20% down, I may not have skin in the game. And if I don't have skin in the game and I end up in a default situation, the bank wants to make sure that they have an insurance policy that they can recover any losses, including my house. Is that right?
Exactly. And the goal is always going to be to get to that 20% equity. Even if you start off with a loan that has mortgage insurance, you can later refinance so you can eliminate that from your mortgage.
So with your organization, how long does it take to get approval? So if I come to you today and say I'm qualified, how long does it typically take your organization to close on a loan? Maybe on average. I know you can't be really specific.
Sure. So it's definitely going to depend on the buyer scenario and property. But I would say most contracts I get are going to be dated for about 30 days out. But I can do in as little as 2 weeks. So it will just...
2 weeks?
2 weeks, yes. Yes, I just took care of that for someone here in this office.
Wow, that's pretty amazing. Okay, and what documents do my clients need to get prepared for their first conversation with you?
Yes, so I would say when we have that initial pre-approval conversation, we're going to ask for your driver's license and identification. Okay. We're going to ask for your 2 most recent pay stubs. We're going to ask for your 2 most recent W-2s or 1099s, 2 most recent tax returns, and then we're also going to ask for your 2 most recent bank statements for the account that you're thinking about using the funds to make the purchase of the home.
Okay. So you mentioned my W-2s.
Sure.
Okay, so what if I am self-employed?
Yeah, so good question. If you're self-employed, then we're going to take a look at your taxes. And we will calculate do the calculations up front to determine how an underwriter is going to view the business that you've had.
Okay.
So we can determine your monthly income.
Fantastic. I like the fact that you keep saying that we're going to do these things up front.
Yes.
Because it's so frustrating when you really think that you've got your the home that you want and you're going to go through the process, but the loan officer didn't do their due diligence up front, and we're going to fall out towards the end, or the terms will change, or I need more money for down payment, things. So I'm glad that you're doing that due diligence up front. Okay. Well, I have one more thing I need from you, and I think that all of our viewers out there are going to need. I need to know what the do's and don'ts of getting a mortgage. What should my buyers avoid? What should my buyers make sure that they're prepared to do? Let's do it in 2 stages. We'll do it in the 6 months before coming to you.
Okay.
And once they make that initial conversation, what should they do or not do?
Sure. So in the 6 months leading up, I would say definitely check your own credit. Pull a report on your own, see exactly where your credit scores are and what's reflecting on there. If there's any discrepancies, that gives you time to clear it up before you even get house shopping and find a property that you like. In addition to that, I would say determine how you're going to pay for the purchase. And if there's funds that you have set aside, mattress money is not acceptable in the loan world. So go ahead and make those deposits. So that way we're ready to go when we need to ask for your bank statements. In addition to that, I would say start thinking about what agent you want to work with so you can find a good realtor, because I work with agents and we're a team to get buyers to the closing table. So you want to make sure that you have that on the forefront as well. Once you get pre-approved, I would say refrain from switching jobs. I would say refrain from making any large deposits in your bank accounts because all money has to be sourced at all times. Go ahead and hold off on any new large debt purchases. So no new cars or no co-signing for anybody if you can avoid it, because we don't want to impact your credit negatively and we don't want to change your pre-approval status. And in addition to that, I would say just making sure that overall you're working with somebody who's going to educate you and get you ready from pre-approval all the way to the closing table.
Well, you mentioned credit, and
yes.
I think credit is really important. I'd like for you to give us some understanding on how is it that people are pulling their credit and they're coming up with different credit scores. Tell me about the mortgage credit score and how that differs from when they're buying a car or a credit card or things of that sort.
Yeah, so credit can be a little complicated as far as like when you're purchasing different avenues as to how that's calculated. So when you see your consumer credit score, that's going to be kind of just an average of all of your lines of credit that you have. When a mortgage lender is pulling it, there's specific aspects of your credit that they're evaluating. So what I can share with you is normally when I have clients who come in and they're reviewing on Credit Karma or maybe a credit card that provides their credit score, there will be a variance there of about 20 to 30 points to when we internally pull a mortgage credit score for them. So that's something we prepare for as well, and that's why it's so important to know ahead of time in case there's anything on there that shouldn't be.
Well, that's good to know. Well, thank you so much for coming in. I really appreciate you helping me to convey a better understanding of mortgage to our clients. This is just one more piece of the puzzle in the home buying experience. So let's get started. Give me a call.